Good afternoon, everybody, and welcome to the E1 Tech Talk. This series was created to share knowledge and inspiration with tech entrepreneurs with a variety of perspectives. Our aim is to encourage and empower, along with equip entrepreneurs on a path to success. A couple of housekeeping things. Everyone is muted, so we can hear Brett and whatnot here really clearly and don't have interruptions. And so I want you all to look at and submit questions by using the Q&A function at the bottom of the Zoom screen. And so would love to get through as many potential questions as we get. So don't hesitate to throw them up there on the board for us. Also, there will be a follow-up survey sent to each person, and that really just helps us. How do we improve, what we do different, or what variety of topics that would be of interest to you, so we can have that for next time, as well as it also helps our sponsors have some data and background of where we're at and what we're up to. Let me share a little bit of background on E1. It stands for Entrepreneurs First. It was created by 15 organizations in Southeast Minnesota, really looking at the same goal of how do we help entrepreneurs. With each one of us not having the same skills or expertise, it just made sense to work with each other to build a platform and build a group that really can serve any type of entrepreneur with an idea and help connect you to the right pieces. And so Entrepreneurs First is only about a year old here, and we're continuing to build upon that platform. You would have seen the 15 organizations right away on that screen that was up at the beginning. And so if you got any questions on that, let us know as well. A little background on myself. So my name is Sam Ziegler. I am the director of Green Seam. It's an economic development organization built to help ag-related and food-related businesses in southern Minnesota and northern Iowa grow and be created, help with the talent side, and really create this brand that we are an ag powerhouse in this region for the U.S. And so anything that touches ag and food, love to work with you and help you out and connect you to the right people. But let's get into the real important stuff, why you all came today and why you're here. It wasn't for me, but it was for this guy that we have on the other picture here, Brett. He is the founder and managing director of the Syndicate Fund. He's an entrepreneur first at heart and in skill, with multiple exits and at least one failure, he says, underneath his belt. He understands how hard it is to build a company. In addition to the multiple hats, he's the managing director of the Techstars Farm to Fork Accelerator, which is focused on tech-enabled companies innovating in the food world. He was formerly an entrepreneur in residence at the Techstars Retail Accelerator and was the director of Techstars startup Next Food and Ag. Brett holds an MBA from the Darden School of Business and is an adjunct professor of the entrepreneurship at University of Minnesota Carlson School of Business. And so that's a lot. It's pretty impressive. And we're going to dive into some of these things of what all does that mean? Where has he been? What's the fun that he's had? And what maybe inspired him to keep going when failure does happen, right? So to kick things off, I think it would help if you provided everybody with some insight, a little bit more into that of your entrepreneurial experiences.
Yeah, happy to do it. And for the Q&A too, I know Sam mentioned this, but anything's fair game too. So we can talk about anything that anybody wants to talk about, from what I'm doing today to like failures or successes in entrepreneurial endeavors of the past past years too. So yeah, I don't know. I always considered myself an entrepreneur. I was, literally the kid in middle school that was selling king size candy bars out of my locker. And so I've always been a bit of like a hustler, like trying to figure out ways to, take $1 and turn it into $3. And so always wanted to build a company. And had the good fortune to do it a few times. And so I've actually run both bootstrap companies where we didn't raise any type of outside capital for it. Actually, my first real company was I took about an extra $10,000 in student loans out while I was in school and used it to start a company, and sold that one 4 years later. I've also run venture-backed businesses, so I've raised some capital from some really great investors that have been supportive and super helpful. I've been fortunate not to have any investors on my cap table that were incredibly difficult or terrible. So I've been kind of lucky in that sense. But I have taken companies to exit. And then about 5 years ago, I moved to the investing side of the world, started working in the venture capital space, started as an angel investor, investing in startups, then raised a traditional venture capital fund, and also got involved with Techstars and run the Techstars Accelerator. My startups have been fairly industry agnostic. So I've been, and I've done stuff in a variety of different spaces. So I built a video game once. I built a company that sold uniforms like medical scrubs, restaurant apparel, stuff like that. I did a company that went out and scraped data from the web, repackaged it, and sold it. Did a digital sales and marketing consulting firm. I did a marketplace kind of like Etsy, but we handled the back end fulfillment for the artists. So it was a two-sided marketplace like Etsy. About 65% of my investment portfolio currently is in the food tech space. So I do a lot of food tech investing. I'm one of the more active early stage food tech investors, actually probably in the world. So I invest and talk to a lot of food tech entrepreneurs, and that really is a core part of our investment thesis and where I play and where I act now. So pretty broad spectrum.
Well, it's a good note to end on here. When you talk, when talk about what you're investing in now, it's food and ag, right? Everybody needs to get fed before they can do anything else. So good space to be in.
It is.
What do you get your motivation from and your passion to continue this? Because there's no coast in starting up companies or investing in companies, right? And so it's a go constantly. Tell us more. Where do you get that from?
For me, it's interesting. When I was a founder, a lot of founders out there are just so passionate about their product. Like it's this thing, like they have like this core passion for their product and love it. And they just can't imagine a world without the product. And that actually wasn't me. And so I've actually never built a business where I was like, the product was like my dream product. I saw more market opportunities with my companies, which is a bit of a different approach. And I actually think that's why I've kind of exited companies a bit earlier than many other people that stay with them. But what I've always loved, what I found in that process and why I love the grind and why like you put yourself through it, because entrepreneurship is really hard. Entrepreneurship is an incredibly difficult thing to do. And unless you've been through it, it's really hard to understand as well. I love the people aspect of it. I love building teams and working with people. On the investor side, I get to do that. I also love learning, and you learn so much about yourself. You learn so much about an industry. You learn so much about other people when you are trying to build a company. And in a lot of traditional jobs, there's a learning curve, right? You're in a role for 2 years and your learning curve is pretty steep. And then after 2 years, your learning curve flattens and flattens and flattens until you take a new role or a new position or go to a new company. And in entrepreneurship, man, that learning curve might flatten a little bit, but it certainly doesn't flatten much from stage to stage to stage. And on the investing side of it, it never really flattens. Like maybe like you start seeing patterns in different founders that you have had success with and things like that. But every time I talk to an entrepreneur that's doing something different, my learning curve is incredibly steep to learn like just what the heck they're actually trying to do. And my goal is never to be the expert in anybody's industry. It's to get 80% of the way there, but be an expert in entrepreneurship and what it takes to build a big company and a great company from a founder level. And so I love the people aspect of it is the short answer. I'm driven by that. I also love the feeling of your success or failure squarely on your shoulders. That always has driven me. And so I love that part of it too.
That's a good point to put at it. It is on your shoulders, right? There's not others to blame or to point fingers or ask why it wasn't done. It's your call, right?
It is. Yeah, completely is.
So one of the thoughts is, is you're helping companies start. Some companies or some entrepreneurs might have an idea of what an accelerator means and what an accelerator for farm to fork means, but I think there's many of us that are still trying to learn and completely, and I think there's some that are slightly different. Maybe it'd be worth explaining a little bit more about the farm to fork accelerator and what you're looking for, and then what you do in the program.
Yeah, there's so many different programs out there for founders right now, which is a great thing, right, to have that, but it does get can be confusing, and and what to do and where to go. Our accelerator, Techstars is, I think it's the largest accelerator on the planet, but it's Techstars and Y Combinator were the first two accelerators around. We operate a little bit differently, but are both really good programs for founders to go through. There's also a variety of other programs out there, but really our program with Techstars is a mentorship-driven accelerator. And so we invest capital and money into these startups. So we actually put money in, we take an equity stake, and really the value in the equity stake that we take is what we bring to the table, more above and beyond the money. So it's not really about the money. It's a 3-month program. The first month of the program, we put you in the room with about 120 mentors that are there specifically to help you. It's an incredible way to expand your network quickly. In our program specifically, we work with Cargill and Ecolab on our program. And how they plug in is they provide about 40 of those mentors. The other 80 come from my network. So it's entrepreneurs that have built successful companies, it's subject matter experts, it's a variety of other things like that. You meet all of these people and they now become your network. Second month of the program, we focus on execution. So throughout the program, we're working on different entrepreneurial best practices and things like that. Second month of the program, you've gotten a ton of ideas. We focus on picking the right ones and executing on those. And third month of the program, we really do tend to focus on investment and helping you get ready to talk to investors and pitch investors. And then you finish the program, and we continue to provide ongoing support forever. So this will be my 5th program coming up this year. And I still regularly talk with companies that came through one of my programs in 2016. And so it's you build relationships with our accelerator and the good accelerators that last forever. Last not just for your current company, but for companies beyond. And so it's, not all accelerators are created equal. So just like anything else, if you're going to give equity up of your company, understand what the value is and what do you want to get out of it as a founder is a really important question to ask. And if you don't believe that the value you're going to get out of it is exponentially higher or greater than the equity ask that you give up, you probably shouldn't do it. So that's a brief overview of what our program is. It really is, our goal is to accelerate a company. We say we're stage agnostic. I'd say the majority of the companies that I've worked with in our program have had product in market. Most typically have people using that product. So it's not, and we've had companies that are earlier, and we've had companies that are, doing lots and lots and lots of revenue. But I'd say it tends to be about a seed stage company that comes through our program. So, there's all other things out there like incubators. There's a lot of different regional programs that are really good at helping companies go from 0 to 1. And I think we're more focused on going from 1 to 10.
That's awesome. That helps. I think that makes a lot of sense. We got a couple questions in here in the Q&A, and I would encourage if anybody else has questions, please submit them. I have a ton that I'd love to ask Brett all of mine, but I'd rather help make sure what top of your mind Brett has a chance to answer. And so I don't know much about the company Boom Boom, but Chris is a startup company with Sherpa. He asked the questions. You see, you ran Boom Boom for a year before transitioning it to full time. Why'd you hold off going to full time, and what made you the decision to transition to full time focus?
So I'm not sure what he's referring to around the full time. I came in 2014. I think it was as CEO of Boom Boom Prints. It wasn't my idea, but the company was super early when I came in and I joined as CEO, and there's a really good. I considered myself a founder of the company still. We raised venture capital for that company. We built a team around it, and we weren't able to like scale it. We weren't able to find marketing channels that would work at scale, or we weren't confident that we found marketing channels that would work at scale. We actually ended up selling the company at the end of 2015. So about 2 years. I think I was working with Boom Boom for about 2 years. We ended up selling the company, but it was at a fairly significant loss. Not fairly. It was basically a total loss for everybody, right? It was a complete failure in my mind. We were able to get real traction with the artists, and artists really appreciated our platform. But we weren't. I don't think we were differentiated enough on the consumer side. And so it was hard to, it was really hard. Our CAC to LTV ratio just didn't work, right? And so I couldn't go out and raise $5 million and say, hey, investors, for every dollar you give me, I can turn it into $3. It was our customer acquisition costs were incredibly high relative to the amount of value that every new customer brought in. And we tried a lot of different things. I actually just posted on that question. On my Medium blog, I actually just posted a letter I wrote to my investors when we decided to essentially shut the company down for all intents and purposes. And so it's the actual letter I wrote them in 2015. And so I would encourage you, if you're interested in more about like how I approached that or how I thought about that, I would encourage you to check it out.
Interesting. I didn't know much about that side of you, so that was an interesting question. As it comes to the food and nutrition industry, Lena asks, what are the biggest challenges that you see should be important to be solved?
I mean, the food system, like as a whole, right? It's you see that a lot of the issues were like brought to bear recently, right? With connectivity and data sharing and under just the relative inefficiencies of moving a perishable product from point A to point C is incredibly difficult. It's incredibly difficult to change. It's not a nimble system, I guess, is where I'm going right now, which is why you had, milk being poured out and milk shortages in another part of the country, which is why you had a lot of the big issues that, you have a bunch of fresh produce spoiling and getting thrown away, and you have, soup kitchens not getting enough food to feed people that are hungry. And so it's a relatively static food system. And so the supply chain itself is an incredibly interesting and fun problem to think about and for founders to come in and solve. I think the employment issue and employee issue is a huge issue right now. There's labor shortages across the entire food value chain, from on-farm all the way to retail. And so, and there's no real sign that that's going to improve. So I think that employee efficiency, I think robotics and automation are really interesting parts of the food system as well. Generally speaking, a lot of the food system is fairly antiquated. Even how humans understand like what they're eating, right? It seem like that, like, something's bad for you and then the next day it's good for you all of a sudden fairly frequently, right? So even understanding like the nutritional side of food, it tends to be a bit of a black box, and there's a lot of innovators and entrepreneurs thinking about that side of it too. So there's just so many parts of the food system that are really fascinating, really interesting to me. And it's not just in the United States, this is worldwide, right? Like at the farm level, our farmers are actually really efficient. Like in the US, like farmers are, they're efficient human beings, right? Like they're good at getting the most out of their land and their crop. They really are. And in the US, there's been a ton of technology adopted relative to a lot of other parts of the world, right? Where if you look at a lot of the African continent, where it's really driven by smallhold farmers that are farming, less than an acre of land. Like, I mean, there's very little technology adoption there, and the efficiencies in markets like that are much smaller. And so there's a huge opportunity in the agricultural industry just to bring current modern technology that has already been invented and deploying it to ecosystems that don't have adoption and deployment yet. And so and that can just make the food system incredibly more efficient and better for everyone. And so it's not just building the next greatest piece of software, the newest like robot. It's also taking what we already have and figuring out creative ways to deploy it. Like deployment's just as hard as coming up with the technology, to be honest. Like it's hard to get people to adopt things.
That's a good point. And, it brings up that delicate balance of how our food system is built, right? There's a heavy placement put on food safety, which US has done really well. And to kind of implement some of those things, sometimes it did create things to change to the way they are today, and the pipeline to get tighter and tighter and more streamlined, but it also has shown its weaknesses here in the past month. No doubt about it. And when you think about where we are in the US compared to these other countries, I farm as well, and I had an African baker from Ivory Coast out to my farm a number of years ago now, and he sat and wept in my tractor because he couldn't understand what we were doing, because they were still using a stick to poke a hole in the ground. And so I've been able to see it firsthand. I guess it makes me appreciate more and more the technology that we're able to utilize here in the US. And so it's a very good point on what the challenges and what opportunities could be like in this supply chain. Pat has a good question here. Pat Baker has said, with the pandemic environment we're currently in, it appears we see a lot of business failures and high unemployment. With that, I think we can expect a flurry of startups. Are you seeing a lot of money on the sidelines from venture capital or angel funds that can handle influx of startup attempts?
So this is an interesting question. It's two-sided, right? I agree that people are going to start companies, but then my question is, when jobs come back, are those founders going to leave those companies and go back to a more stable position or role? And so I actually am not confident in what the long-term effect as far as actual sustainable startup creation is going to be from a job loss event like this. And so, I am very bullish that there are going to be great companies created this year, right? Like there's going to be amazing, world-changing companies created during this economic downturn, just like there were in 2008, 2009, right? And everybody always points to Uber, Airbnb that were built during those times. And you can make the argument that neither of those would have succeeded if they had been created in 2015 when the economy was smoking, right? Because who wants to rent out a room in their flat when you got plenty of money? And so I'm very confident there's going to be great startups and entrepreneurs, new things founded right now. Is there going to be more great startups founded today than there would have been otherwise? Or is it the same founders? And I don't know the answer to that. And I think that's okay. But I do think that it certainly forces people that have been on the sideline or working somewhere else to, out of their comfort zone potentially, and might make them try something new. And so we will have some new entrepreneurs that realize they absolutely love it. And they were just their hand was forced into it right now. So that's exciting for me. I love the idea that there's going to be more founders, more people starting companies. That is, I love it. It's exciting. I hope they do. It'll be worthwhile for those people, regardless if they succeed or fail. On the capital side, over the last 3 months, certainly a significant portion of private capital has been sitting on the sidelines, especially at the angel level. At the angel level, people are. If you're an angel investor, you're not risk averse, right? Because you're a risk taker if you're writing venture capital checks. However, anytime there's uncertainty in markets, it does create an additional hurdle for those angel investors to write checks. And so, so right now, I think that some of that uncertainty is starting. You're starting to see a little bit of the cloud of uncertainty dissipate, but certainly hasn't completely gone away. But over the last 3 months, investment certainly has slowed down. I'd say about 50% of the funds have continued to invest. We've actually closed 3 investments in the last 3 months out of our fund. So we've been actively investing during the process. And one thing about the uncertainties, I think people naturally think about, what's going on today. And for me, the uncertainty is actually less about that. And it's more about where valuation is going to be a year and a half from now. So, because if I invest today, am I going to get valuation bumps a year and a half from now or not? Because if not, then I might as well just wait a year and a half and see how these companies do. As an investor, there's very little incentive for you to invest other than this thing is going to gain in value if I invest early. Otherwise, like if it's not going to gain in value over time, there's no real purpose or point in investing early as an investor. And so, so I think that's where a lot of the uncertainty comes from, is around like future valuation risk and future financing risk for investors today. But I think that you'll generally start seeing the private capital markets open up. I don't know that I think there will not be more capital at the back half of this year than there was coming into this year. I think if anything, you'll have less capital available for startups. And I think that you'll see a continued flat and or down effect into 2021 around capital availability and liquidity in the market for startups. If you look at like 2000 to 2002, there was, I think it was like over an 80% dip in venture capital invested from 2000 to 2002. In 2009 to 2010, it was like a 20% dip. I think you'll probably see but by 2010, it was back to the levels of 2000. By 2011, it was back to levels of 2009. And so I think you'll see a more similar trajectory to what happened in 2008, 2009, 2010 than you will in 2000, 2001. And largely that's because the 2000 to 2002 event was actually largely caused by startups and venture capital, right? Like the fake IPO market and just like a crazy amount of money getting poured into startups then drove that recession. Whereas in 2008, 2009, 2010, the recession was not driven by startups, it was driven by real estate largely. And so the entire economy was affected, including venture capital and including entrepreneurship. And I think that this is more similar of an event to 2008, 2009 than it is the 2000 to 2002 event. So really long answer to a very tough question that nobody actually knows the answer to. But there's capital out there. One thing to keep in mind is like all these venture funds. There's in 2009 there was about 100 micro venture capital funds in the United States. So venture capital funds that were managed less than $100 million in capital. Right now, before the pandemic, there was about 1,000. So there was 10 times more micro venture capital funds in the United States in 2020 than there was in 2009. And those funds have committed capital. And very few LPs actually kind of renege on those commitments. Like there's legally binding contracts that they have to provide that capital. And so, I mean, there's dry powder out there, right? And as a fund manager, my job is to deploy that capital, right? My job is to get that capital invested and give it to companies. And so, I mean, and I'm incented to do so, right? Like I don't really make money on a venture capital fund unless I make investments and those investments do well. So there's capital out there.
Well, that leads into a good question that could be worth just exploring about. When you talk about the capital and you talk about VC funds and micros and, there's all kinds of names. Maybe it'd be helpful just to, take it through what kind of some of these stages mean, and that people listening should have just a little flavor to make sure that we're talking the same page here. Yep,
totally. So names kind of matter not that much. Like there's so much gray area between any of this shit. And there's no hard and fast rules to raising capital either for a startup. Like there's like general like thoughts, but there's always exceptions to every one of these rules. But in general, like typically when you first start a company and when you're at the idea stage, almost all the money comes from friends and family. Your friends, family, grants, sometimes nonprofit organizations, depends on where you're at. Like the first capital is almost always friends and family. They actually call it a friends and family round. And that's like what you use to get started, to build an MVP, to build your first product. You're not going to, very rarely can you go to a venture capital fund, like a venture fund, and say, hey, I have this idea in a thing on paper, on a napkin, and raise money from that fund. That doesn't happen very frequently. It does happen, but not very frequently. And in the Midwest, it happens even less frequently. That happens on the coast occasionally, but in the Midwest, it very rarely happens. The The next stage is usually an angel stage. So I would call the next stage like a pre-seed round. And that's usually raising anywhere between $250,000 and $750,000. And you use that round to take your MVP, bring it to market, start getting users, start getting some early feedback on your company and what you're building. And that's going to come from your network that is usually like the +1. So your friends and family and +1. So who do they know that might be interested in investing? It also comes from some angel groups. There's angel groups in across Minnesota in different regions. So it comes from angel groups. It comes from other organizations like that. After that, you'll go into the seed round. A seed round right now tends to be anywhere from like $1 to $3 million. And that's usually the first time venture capital funds really come to play, is in that seed round. And so that's where the funds really step in. Some funds do invest in pre-seed rounds, but not many. We actually do invest in pre-seed rounds, but we're more unique than the rule in that, I would say. And oftentimes an accelerator can play a role in that pre-seed and seed stage as well. So for that $250,000 to $750,000 type range, you know, if you've raised that, oftentimes that's right after you've raised that is oftentimes a good time to go to accelerator. So like between that pre-seed and seed stage, an accelerator can really help your company. Sometimes some earlier stage accelerators will even do it right after that friends and family round and help you get to that pre-seed round. That's a good place for accelerators play. And then you get to like an A round and a B round and a C round and growth capital and beyond. But really, like, I think the most confusion is in those first couple of rounds and understanding like who is appropriate to, who you should be talking to, because it is really time consuming to raise capital for your business. And like, you know, for my first venture fund, I pitched 147 people. And so, you know, like it takes a long time to pitch 147 people. And I had a good network and good connections to do that. And so it would have taken me 3 years to do that if I wasn't pretty well networked into the entrepreneurship world, right? And so you have to pitch, you know, to raise any round. I always tell founders, assume you're going to have to do 50 pitches, and 47 of those pitches are going to be no's. 3 of them are going to be yeses, right? And so it takes a lot of no's to get a couple of yeses.
That's a good point. That was, you know, one of the questions from our audience, you know, Mark, was, you know, when do you invest in a company and what's the investment per, you know, dollar? And I think you summed it up pretty well there, that, you know, there is a lot of variation and a lot of variability, but overall it's, if you have an idea, you got to find that right individual or that right fund that sees your project matching their knowledge and their strengths, right? Because if you don't have a knowledge in something they pitch you, what's your easiest answer to give them?
Yeah, no. I mean, we say no to more. I say no to way more companies I say yes to, right? Which is unfortunate because I want to say yes to everybody, but like, you know, my job is like, as a fund manager, it's like I have a fiduciary responsibility to my investors to try to, you know, and my job is to make them money, right? I mean, my job is to take the money they've invested in me and make them more money. That's my job. And the benefit of my job is I get to help entrepreneurs build really cool shit, right? Like that's why I love my job, is because I get to work with entrepreneurs.
So when you're talking about entrepreneurs and helping them, and we're talking about, you know, being ready for that pitch and being ready for lots of pitches, what are 3 key things that it's a must do, or don't go there yet. Don't set up a meeting and then flop it, because you don't get that chance usually to go back.
Yeah. I mean, do your research on whomever you're pitching. So get to know, like try to understand who you're pitching. And if you can, try and talk to a founder that they've invested in before, because that can be a real wealth of knowledge for you. If you have, you know, I'd say that most first pitches are either like 20-minute, you either have like a 20-minute time slot or a 30-minute time slot. So most of the time, like with me, most of the time I get pitched, it's either like a 20-minute calendar invite or a 30-minute calendar invite. So that's how long you're going to have. Don't take the entire 30 minutes talking. Spend 10 of it talking and then leave 20 minutes for Q&A, right? So make sure you, I think that's a real common mistake a lot of founders make, is they just like talk the entire time and don't allow for Q&A. And Q&A is often the best part. Like I actually personally prefer not to get pitched off of like a deck. like a pitch deck. I like just have a conversation with entrepreneurs the first time I meet them. And then I ask for the deck as more of like, here's some leave behind material so I can reference it. But I prefer to just have a conversation with the founder. That's where coming in and talking to a founder that I've invested in would be helpful, right? Because some venture capitalists love getting pitched off of a deck. And so if you talk to a founder, they would tell you, oh yeah, Brett, just go talk to him, right? But with, XYZ investor, you got to have a deck ready to go, and they want you to formally walk through it. And so so do your research, right? Do your research. On the research part also, it's understand if you are a good fit, right? And because you don't want to really waste your own time. It's not even about wasting my job is to get pitched by founders, so you're not wasting my time, even if I end up telling you no. But again, building a company is really time consuming, and there's a lot of time constraints. And so don't waste your time. It's worth the 5 minutes to do research to see if you're fit for a potential fund, rather than spending, an hour trying to get connected to that person and then an hour pitching them, right? Like it is actually, even though it might feel like you're wasting time doing research, like you'll save yourself time in the long run. If it's just not a fit, like I invest in food tech, retail tech, marketing, advertising tech mostly, right? Like if you're a health tech company right now, I don't invest in health tech. So like, don't pitch me. I'm probably not going to be very helpful to you either. So I'll be nice, and then at the end of your pitch, I'm going to be like, I don't invest in health tech. Like, good luck. So do your research up front. Was another really good one. I think that understand founder dynamics. So like, I prefer to invest in multi-founder teams. So I prefer to invest in teams that have multiple founders. And when I meet the two founders at the same time, if one founder's talking over the other one, that can be a common mistake too. It's just your dynamics in that pitch.
That's a good kind of lead into another question that we've gotten from the audience. I'm going to blend it in with the question I had from me is just thinking about is how do you build your right team, whether they're truly a founder or a board, or how do you find the right expertise? And so SC asked, what are good ways to find a non-technical or for a non-technical founder to find a coding expert? And I think that question fits in really well. How do you build your right team when you don't have capital just to start writing checks out to find the smartest person that you've heard on,
Yeah. I mean, there's no magic bullet to like doing that, right? Put yourself out there, right? So get out there, go to events, go to things like, how do you put yourself in situations where you'll have intentional collisions with the people that you want to meet, right? So if you're looking for a technical co-founder, where are those types of people going? What are the types of events or things that those people are doing? So make yourself uncomfortable and put yourself into situations that you'll accidentally run into those types of people, so you can build those relationships and find those types of people. And so that is the best way to do it. There is no ideal way to do it, but that's the best way to do it. And then leverage your network, right? So like everybody you talk to, like everybody in your direct network, say, hey, I'm looking for like a technical co-founder. Do you know anyone? So have that conversation 100 times. And eventually somebody's going to say, hey, you know what? I know a person that might be interested in the project that you're working on. And so those are two ways to do it, to find those teams. And then take your time, make sure you protect yourself, like have a really good operating agreement, make sure you have vesting schedules on your stock, like some really basic best practices around legal and the organization of your company are pretty important. I don't need to get into those right now, and there's a lot of information about those out in the web that you should Google. But just finding the person, it's putting yourself in positions that you can potentially run into those people. Like sitting at home, like thinking about your idea, you're not going to run into that person.
That's a good way to look at it. I appreciate that. We still got some questions here, but really love the audience's questions. So please keep sending them in. There should be a Q&A box at the bottom of your screen. Plug it in there, throw the questions out here, and you can also vote on other people's questions if you really like that one. It helps raise it up and when I'm looking at them. So keep those questions coming in. One of the questions Chris asked is, how do you make the transition to starting a fund? Or how did you do
Um,
this? What does this look like? Is it
it was
accident?
actually hard. It was actually harder than I thought. I started angel investing and then I enjoyed it. So when we sold exited Booming Prince again, which was more of like a shutdown than a sale. Um, if you'd asked me then what I'd be doing today, I would have told you running another company. So I would have told you I would be CEO of another startup. That is what was in my head. I was EIR at Techstars first, right away. And my job at Techstars was like, hey, help us spin up the Techstars retail program. And start your next company while you're doing it, right? Come work for us for 6 months, and start working. Use that 6 months as like a bridge to starting your next company. And so that's what I was going to do. And I started doing some angel investing. Really started enjoying the fun side of it. And then again, since I've been an entrepreneur for so long, I had a pretty good network, and I was like, I'm going to go raise a venture fund. This is easy. And it was really hard to raise the first venture fund because I got zero credit for having been an entrepreneur. But I had a network of high net worth individuals that I built through that process. And so I had a bunch of people that knew me really well and trusted me well enough to write me really small checks. And so my first fund was tiny. It was kind of like a prove it fund. And then we deployed that in a year. And then we raised the current fund, which is much more substantial. Like I said, I had to pitch like 145 people to raise just over $1 million, right? Like that's not much money per pitch. So I pitched a lot of people and the people that gave me money were the ones that like, again, just knew me really well and just trusted me. And they're kind of like, what's your stupid idea? All right. Like, I'm not going to give you much, but I'll give you a little bit, just to test it.
That's awesome. That's a good way to look at it, though. You think you got the network, but it was a network that you used for other reasons, not necessarily for that particular reason. And so it's impressive. So now, how many years ago was that?
That was 2006, like end of 2016. We started raising that fund, or 2017 we raised that fund. So yeah, in 4 years.
What's your fund size today, or how do you look at that?
Our current fund's about an $8 million fund. Our first fund was about $1 million fund. The next fund will probably be, bigger than this one, right? And you keep proving yourself and doing better, and you can typically, raise more and more. So the next fund will hopefully be much larger.
So what's the magic formulas for how an entrepreneur, when they start their business, would provide equity to, whether it's to the board, whether it's to founding members, or whether it's to, some of the funds out there, definitely want the equity stake, right? So how do you as an entrepreneur evaluate, especially in early stage where you don't have sales yet, right? So you're
totally. So like valuations, like don't even worry about valuations at the early stage, right? Like valuations are like, it's a bunch of, like who knows? And oftentimes like valuations that are set at the early stage are more based on potential and less on like what you're actually worth in that day, in that moment in time. And they're also based on, hey, like we're going to put $500,000 in this company, but like this entrepreneur, we need them to be incented and remain incented. So we can't, even though the company's probably not even worth $500,000 yet. Like if you tried to sell it today, nobody's going to buy this thing as is today. The value is in that entrepreneur and that team. And so good investors understand that and understand that there's just real value in those teams. So as far as giving equity to people, a couple things. Like I'm a believer that investors, if they're an investor, they should not need additional advisory shares. They should be invested enough in your company to want to help you just through the investment that they've made. So I don't take advisory shares in companies that I've invested in. I don't need that extra incentive. I just help them because I invested. Now, advisory boards are another issue. And so most companies will have like on their one slide on their deck that says, hey, look at my great advisors that know everything, right? I tend to discount those as an investor because I'm like, well, how active are those advisors actually in your company? And, maybe 1 in 100 companies actually has a really active, supportive, very beneficial advisory board. Most are like pretty passive and don't really do much. And so if you're going to give shares out to an advisory board, market for advisory shares are anywhere between like a quarter point and a point. So 0.25% to 1% of your company tends to be in market range. and like depending on who that person is and what they're doing for you. And then you should vest those shares over a certain period. So don't give them to them up front. Have a conversation. Say, Sam, like, here's what you and I have talked about. I'd love to have you as an advisor for my company. Like, here's the things you said you could do for me, right? And so that could be anything from like, hey, you said you could have a monthly meeting with me, 1 hour every time, once a month, just for me to talk through the things that are on my head. It could be, you said you could bring 3 clients to me. It could be, you said you're going to help me fundraise. It could be a variety of things. Like, vest those shares based on whatever that value you want to get out of that advisor is. So don't just give them the shares, make them earn them, right? And good advisors, people that are really really do want to proactively help you, they'll be like, yeah, let's do it. I'm ready. Let's go to bat. You know, like, I can give you an hour of my time every month, just like, and we can use it however you want, right? And so vest those shares over time. And then anytime you give out equity, no matter what it's for, whether it's for an advisor, for an employee, for dollars, for an accelerator, in your mind, you need to believe that the value creation is going to be exponentially greater than the shares you give out. So let's say you give 1% of advisory shares to Sam. Like, you need to believe that the value that Sam is going to bring and build to the company is going to be worth 3%, right? Otherwise, why would you give it to him, right? So the value that that person or those shares given away drive in your company have to create a greater pie, a bigger pie. So your remaining 99% is now worth more than it was when you owned 100% of it. And if you don't think there's a path to that based on giving out equity in your company, then you shouldn't do it. That being said, like, I'm actually really pro giving out equity. Like, I think in the cases where like, oh man, like Sam can really help me, he's gonna like give Sam some equity, right? Like, give that person or that advisor or that accelerator or that investor, like, don't, you know, first-time founders tend to be like, hold on to equity more tightly. You know, like, I've started probably 7 companies. Like, by my last one, I'm like, who are you? Like, what can you do for me? Like, you can increase the value of my company by 10%. Like, here's 2%, right? Like, you know, it's like, great, like, let's do it. And so, you know, you tend to, more senior founders tend to be, they understand the value of equity better and are more willing to give it out when they see the potential value that whatever they're giving that equity out for is. So yeah, when you see somebody that can drive value for your company, don't be shy about it.
That's good to know, because most of the time you do run into the newer ones and they're like, well, I can't give up equity. I want your investment and your advice, but I can't give you my equity. So it's interesting how you've changed over this, you know, 20, 30 years of entrepreneurship to say, no, they bring something. I've identified that. Roll with it. So,
and then put them on a vesting schedule, right? Like, you know, protect yourself, but like, but if they add value, man, like, you want that. You want people to add value to your company.
That's awesome. Question is, you know, a couple of them here, we'll make sure we try to get through because we're only about 11 minutes away from 3 here, is, you know, where do you see the future of nutrition going from your platform perspective? What's that going to look like? That was from Lena, by the way.
Yeah. Hi, Lena. Really broad question. You're probably better qualified, like Lena, she's probably better qualified to answer that than I am. Around the future of nutrition. You know, it's interesting. There's a ton of startups that are out there that are thinking about the personalized nutrition, right? And where every single person understands that, like, this is exactly what gets put into your body and what the optimal mixes of whatever you put in your body are. And it's a graveyard. None of them have caught on. None of them have been successful yet. It's a graveyard of startups. And I don't know if it's because the market's not ready. I don't know if it's because people really don't care. I don't know if it's just timing's not right yet. But I think part of it also might be that this is built into timing, but it's just too much work for a consumer to actually act on that information. So it's like, great, you gave me that information. Like, how do I actually, you know, like, maybe I'll do it for like a week, but then it's like, oh, that was way too much work. And so they fall off. And so as the food system gets more and more automated, I think that you'll see the drive for the personalization of nutrition, both at the human level and the animal level, really catch on more effectively and efficiently once the delivery of that nutrition becomes easier and more cost effective. That's the other piece too. It's like, you know, the people that have adopted it are people that also have the means to adopt it. And so right now, like, it's more expensive to do those types of things. And so mass market can't afford it. And so until the cost of having personalized nutrition schedules and the ability to conform to those personalized nutrition schedules comes down to the point where it's just as expensive as shopping for my groceries at Walmart, you're probably not going to have mass market adoption of it. But and how you get there is probably through the automation of it, automation of the delivery of it, and there's a world where that's going to happen. I think. I mean, I think there's going to be like a Keurig machine for meat at your house, where like you can like push a button and a T-bone steak drops out one day. I think we're a little ways away from that still, but I genuinely think that's the truth. And at that point, you could push a button, it knows that steak's for Brett, and it's like the personalized nutrition steak for Brett. Like Sarah, my wife, gets her steak, or you know, whatever it is you want. Like, but I think that there's like there's a world where that's going to happen probably before I die.
Isn't it partly too, you know, you have this being built more in your top athletes, right? I mean, they're getting what their body needs and nothing more, nothing less. But the average person that likes beer, that's got a belly, that gets older is like, it's about the experience. I'm going to go have that steak or shrimp or whatever with my friends. And it's, you know, I'm not going to go, well, tonight I can't go to that restaurant because I need to, you know, press my food. I think that's a little bit of the food world now, is all about the experience as much as it's about nutrition.
Yeah, and there's a world where there's a world where you'll still be able to have that experience and the nutrition will be delivered, but it's a much more fully autonomous world probably, and data intrusive world. So you have to be comfortable with like that part of it too. But like, there's a world where that happens, I think.
That's it. That's could be a fun topic. We could spend an hour, I think, on this topic. Or maybe a couple questions here left. So if you got them, throw them in here. The one thing I think about is, and Pat Baker also says, is what's the demographic, you know, age of an entrepreneur that does this pitch, you know, what's their background, that type of thing. Because I think often there's a lot of people that think that the youngest people have the most ideas, as they're more free to just to go. But then I'll hear another group of people say, no, it's really your 30-year-olds that after they've kind of got comfortable in their house payments and their life, that they're willing to stick their neck out. What do you see?
In our last class, we had a founder that was 19 and dropped out of college to do his startup. And we also had a 65-plus-year-old man. And so it runs the gamut. I believe that anybody can be an entrepreneur. I don't care like how old you are, where you're from, like what you look like, what's your religion. Like, I mean, the cool thing about entrepreneurship is anybody can try it. There are certainly advantages given to different people from demographics, whether it's intentional or unintentional. That's a fact. And there's a lot of people doing work to level those playing fields, but it's not level yet. But you can do it. And we work with entrepreneurs across the entire gamut, and our portfolio reflects that. So, like age-wise, like I'd say our average age of our portfolio, like of our like Techstars companies, has been like probably a bit older than most people would think, where it's more of that like mid-30s, late 30s, not just somebody that's just right out of school.
It's always fun to hear the stories of that the class that you have, and have the 19-year-old in there with the 65-year-old retired person or whatever, and thinking about how they're gonna take their business forward. So that's awesome. One last question I have that I've just been dying to ask is, as America has changed, less and less people are connected really to the food system. And we're seeing a time now where there's more people always interested in food, but they don't have this knowledge. And so they seem to shy away, saying, well, I don't know ag, I don't know production, I don't know farmers, I don't know, et cetera, and come up with, reasons maybe not to. How does somebody that maybe has an idea get into the food and ag system, and how can you help them?
Yeah, I mean, I think it's like, go to people like you. right? And talk to people that are engaged, that are also willing to talk to entrepreneurs, right? So go to people like you, Sam. Go to people like Grow North, that's in the Twin Cities. Go to people that their jobs are to connect entrepreneurs or people that are interested in the food system to the food system. Go talk to a farmer. I mean, again, just like finding a co-founder, put yourself in situations where it's intentional collisions with the people that you want to get involved with. I have never been a farmer myself, but I've walked through broccoli fields while they're being harvested and talked with the harvesting crews, right? Because I put myself out there, and it's a heck of an experience, and you learn a lot when you do those types of things. And so, you gotta just put yourself in situations where you can learn. And it's always understanding entrepreneurship. Nothing comes easy. Nothing comes easy in entrepreneurship. Nothing. If you don't proactively try to make it happen, it is not going to happen. But the beauty of entrepreneurship is that if you do proactively try and make it happen, people are usually willing to help you. You're going to learn a lot, and it might just work. And so, you got to put yourself out there and do it, though.
That's a good point. Is there some last, ending comments here that you want people to think about that are listening here today and, swimming in information right now?
I usually end on two things. One is like, if you're thinking about starting something, just start it. Go do it, right? Take the first step. It doesn't have to be, I think a big block for a lot of people that want to be entrepreneurs is they think their product has to be perfect in order to launch it. No, it doesn't. Just take whatever your stupid idea is, write it down on a piece of paper, and go try and sell it before you have anything and see if anybody's interested. Just start working towards whatever that end goal is. If you're not interested in being an entrepreneur, but you're just interested in entrepreneurial spaces, help an entrepreneur, right? Put yourself in a position where if you run into a founder or you run into a startup, just be like, hey, how can I help you? Can I make an introduction for you? Can I help you with some advice? Do you need some money? Can I help you try and find some money? Put yourself out there and try and help a founder.
Well, that's great to think about, because there is a lot of expertise that we have in our region that probably would give some advice, or whether it's tax or whether it's engineering or whether it's whatever, just because I think it's, they want to help out, but they can't do it unless you ask, right? So.
Yep, exactly.
Well, this has been a ton of fun. And hours went by fast. I got through only a part of my questions, and I see there's a couple questions out here on the Q&A yet, so apologize to those that I didn't quite get your questions for. You surely can follow up with Brett or I. Our information's definitely on our websites. Brett, what's your website?
Probably the best place to track is on social media of what's going on. But it's just Brett Brohl at Twitter, and most of the stuff that gets out. I also do a ton of videos around short 2-3 minute snips on YouTube around, usually it's one actionable thing founders can do to improve their chances of success. So if you just Google my name and YouTube, you'll find it. But there's a bunch of crazy stuff on there. I think I've got about 100 videos up of entrepreneurial best practices there.
Awesome. That's good. I didn't realize that, so I'm gonna check those out. Appreciate that. So again, on behalf of Entrepreneurs First, really thank you, Brett, for taking the time today to share with our audience, and thank you for the audience that was able to join in this afternoon and hopefully take away something from this. We do really need everybody to fill out a follow-up survey. It helps us because we're out here trying to gain your insight and help you out. And so make sure you respond to that survey. And thanks for Jamie with the Collider, working in the background on our tech to bring this all together and make sure things click well for us. So really appreciate that, Jamie. If you have any questions, the Entrepreneurs First, you can look us up on Facebook. We also right now have a shared page on Red Wing Ignite, one of our partners. So check them out there. And thank you for your time.
Thanks, everybody.